You've set aside some money for investing, but there are a whole lot of businesses out there. Where do you even begin? The answer to that is, what are you interested in? Warren Buffett is famous for refusing investment and businesses that he doesn't understand. This is why he tends to stay away from tech stocks at first. Instead, he invests in brands like Coca-Cola, Kraft Foods, and businesses like banks, airlines, and American Express. Buffett understands the companies whose stocks he buys. This means that he knows what they offer, how they operate, and he can see the value of their products or services. Buffett has used the phrase circle of competence to describe the sweet spot where your interest and investment meets. You can figure out your own circle of competence by asking some basic questions about your interest and your understanding of business success. Start by listing the kind of businesses you've worked for. What industry are you in? Does your company have clients that specialize in certain areas? Has your career given you some insight into any particular industry? List the businesses you tend to spend on, or what are your favorite brands. Maybe check your bank statement and see what names that keeps popping up. Finally, write down all the areas of expertise and your hobbies. Are you good at cooking? Do you have passion for hiking? Can you code? Just jot all this down. Put these three lists together and create a Venn diagram of what you love to do, what you are good at, and what you spend on. At the intersections of your Venn diagram, you should be able to identify some industries and categories of businesses that fall in your circle of competence, and that right there is where you should start looking for companies to invest. Another investment strategy Buffett uses is identifying companies that came with a buffer against losses. He referred to that buffer as economic moat. An economic moat is a distinct advantage a company has over its competitors that allow it to protect its market share and profitability. It is that one thing that is difficult to mimic or duplicate, like brand identity, patents, and thus this creates an effective barrier against competition from other firms. Many of these businesses have been around for a while. They've resisted all the bulls, bears, and cultural trends that come and go. Just think of Coca-Cola. It is a company whose reputation has endured both depressions and world wars. Generations after generations keep finding it appealing. Some brands like Pampers are such a household name that we sometimes confuse the name of the brand with the product. We'll say I'm going out to get some Pampers instead of saying I'm going out to get diapers. Pampers and Coca-Cola are examples of these businesses with an economic moat. Another important factor to consider is to ask the question, can a product set a higher price range and still attract customers? Nike can, McDonald's and Burger King can both do it. These are businesses that are probably going to dominate for a very long time. Another indication of an economic moat is the presence of an economy scale. It is frequently linked to having production strategy that is inexpensive yet effective. Companies that have this can beat competitors by offering their goods and services at cheaper price. Amazon is arguably the best example of this. When you buy on Amazon, you frequently discover low prices that are unbeatable anywhere else. Still, economic moats do not last forever, especially if the company's product or service is too reliant on innovation. This is if their product is always changing and have to go through remodeling to survive, which is in the case of some technology companies. Here's a question I'd like you to answer in the comment section. Do you think that Apple has created a strong economic fortress? Some argues that its popularity is dependent upon Apple staying ahead of the game. They said it is possible that a new and more innovative product could come and render the iPhone obsolete overnight, while some think Apple has achieved the Coca-Cola level of brand identity that enables them to keep their market share, thus giving them a wide economic moat. I'd like to know what you think in the comment section. Imagine for a moment that something weird happened and you find yourself in a world where you can purchase $4 for only $2. How many dollars would you buy? You said, as much as you can. I thought as much. That is what value investing is about. If you use the first two approaches to come up with a list of companies you would like to invest in, you can take it further and use value investing to know when to invest. Generally speaking, you want to buy their stocks when it is undervalued and about to increase in value. The net approach is essential to this. It was created by Buffett's mentor Benjamin Graham and serves as the foundation for value investing. Net is all about comparing two numbers. The first number is the company's NCAV or net current asset value. It is also known as the liquidation value. The second number is the NCAV per share. When a business liquidates, it sells off everything and then pay off its debts. Whatever is left goes to the shareholders. That leftover is the NCAV. That's why it's called liquidation value. Fortunately for you, you can get it from the company's balance sheet. Let's say you got your eyes on a company called Fenti Construction Company. According to their balance sheet, the firm's entire current assets are $700,000. On the other hand, the total liabilities, which include all debts, come to $650,000. Fenti's NCAV is therefore $50,000, and that's the first number you need. To get the second number, which is NCAV per unit share, you would need to total up all the company's outstanding shares. Let's imagine that Fenti's business has 20,000 shares in circulation. Dividing 50,000, the NCAV, by 20,000 shows that Fenti's NCAV per share is $2.50. That brings us to the question, what is the stock price for Fenti's construction company right now? Are its shares currently trading for less than $2.50? If so, then the stock is cheap. This is already a strong indication of a potential investment, but the net approach takes things a bit further. According to Benjamin Graham, the present share price should be one-third less than the NCAV per share. He thought that the best opportunity comes at around 33.3% margin of safety. Therefore, the best time to buy Fenty stock is when it's trading around $1.60. Here's a warning though. Though research shows that investing in undervalued companies is an effective strategy, as it definitely beats guessing or simply following your gut, you have to keep in mind that there is no such thing as certainty in the financial market. No strategy will work 100% of the time. In fact, after investing in an undervalued stock, the stock can get more even undervalued and you might end up losing money. Being patient is a tactic you can use to get out of this situation, because the majority of the time the business actual worth will be realized and your investment will then yield a profit. What if you are a beginner and everything I talked about seems like a lot of work for you to do? If you don't want to go through all that math, I have a video that talks about investing for beginners, where you can get your investment passively managed with no cost at all. Please do check it out.